Hello. The Reserve Bank of India surprised market participants on June 6th by announcing a preemptive rate hike of 25 basis points. All 6 MPC members voted for the rate hike. While announcing the same, the Reserve Bank of India attributed its decision on 3 important developments since its April policy. Number 1, a meaningful increase in core inflation which remains sticky and uncomfortably high. Number 2, a sharp increase in households' quarterly inflation expectations over next 3 months and 12 months by around 1 percentage point on average. And 3, incomplete pass-through of the recent increase in crude oil prices since April, which could push headline inflation further up. Consequently, the Reserve Bank of India revised its inflation forecast for the first half of the financial year to 4.8-4.9 and by around 30 basis points to 4.7% for the second half, with risk tilted further up in case of higher than expected revision in minimum support prices for the farmers later in the year. We believe there is potential for 2 more hikes this year, as average inflation for FY19 is likely to be around 4.75% as against the Reserve Bank of India's target level of 4%. There is another angle to the RBI's decision of a preemptive rate hike in our opinion. We believe that the Reserve Bank of India may be getting concerned with 2 emerging trends of a decline in dollar liquidity and a sharp increase in the supply of US Treasuries. Together, these 2 powerful trends may have potentially negative impact on selective emerging market currencies and emerging market bonds in the medium to long term. Further rate hikes by the FOMC and a gradual reduction in bond purchases by both the European Central Bank and the Bank of Japan may also put pressure on the emerging market debt and FX. While key Indian macroeconomic parameters are much better as of now, the RBI may be worried about persistently higher current account deficit and FPI outflows so far this year amid signs of gradual unwinding of the global carry trades. All these developments call for a vigilant central bank and hence tighter monetary policy in the pipeline. So what should investors do? We believe caution should be in order. That said, the recent increase in bond yields may provide investors with excellent opportunities to increase exposure in high quality bonds maturing in 2 to 3 years in a gradual manner. While we do not expect an instant gratification from the bond market, we recommend investors to spread out their investments over 3 to 6 months to take advantage of the rupee cost averaging and tackle vagaries of the bond market. With headline inflation closer to the peak and crude oil prices remaining range bound, we firmly believe that the risk-reward ratio is moving in favor of the investors. A patient investment approach in quality assets may be the key to healthy returns in turbulent times. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.